It's about protecting their life, their thing that they've come to become comfortable with, you know, the way that they were living, the way that they got to be living with you. So you're protecting them. That is the primary focus of your life insurance. Okay. Primary focus. Is the people left behind. I can't spell. Okay. Now, there's some terms that go with this. The person who gets the money is called a beneficiary. So when you hear that term or see that term beneficiary, you're talking about the person that gets the money when the other one dies. Okay. Just like health insurance, the policyholder pays a premium for the coverage. Monthly, yearly, kind of depends on the life insurance. Some policies make them pay half each 6 months. Some want it all up front. Some want it monthly. Kind of depends on the plan. Okay. Kind of depends on which plan you have. And that's what, you get that figured out when you're getting the policy. Okay. You get that figured out when you're getting the policy, what the payment structure is going to be. Okay. One moment. I need to put a mark on here. Okay. So some employers have life insurance available for purchase by their employees. Okay. As a benefit of the employment. Not all, but some do. Like my Loda Unified for teachers, along with giving us the option of having the medical and the dental and the vision, they give us the choice of having like disability insurance and life insurance and these other things. And the benefit of that to the employee is the fact that the company is big enough that they can go to the insurance company and say, hey, I have all these people in my pool. Do you want my business? And if it gets the better rates, okay, is what it is. Okay, so now we got to look at the role of life insurance. Okay, the role of life insurance. It is part of the financial plan. To make sure that those who depend on you have financial support when you die. Okay. Remember, like I said, those that are left behind. Okay. Life insurance is critical for the primary income earner. Especially when you have dependent children. Okay. You want to make sure you're protecting the person that's bringing in the most income for your family, that there's going to be some money to live off of if they should die. Life insurance doesn't necessarily, it doesn't make up for the fact that they're gone. It doesn't often make up for the total that they're going to lose because they die, but it gives the family time to grieve and get themselves on their feet and figure out what's going on through the traumatic time period. Okay. Okay. Sometimes people can get a small policy for what they call final expenses. Okay. What kind of things are final expenses for a person who's died? What do we mean by, do you think, if we say final expenses? What kind of things does the family have to pay? The funeral, yes. What else? The grave site, the cremation, the headstone. Maybe they had some medical expenses at the end. Okay, so this would be the funeral, burial, headstone, final medical costs, things like that. Okay. The reason why they do that, sometimes the people can get a small policy for final expenses because final expenses can be very costly. Okay. My father passed away December of 2019. Just to put the ad in the newspaper for 1 week in 2 newspapers so that his friends in the area who hadn't known he died yet could know was $1,000. 2 newspapers, 1 week. They showed it one day, Sunday. $1,000. And he was cremated, and this and that, all these things that my stepmother had to deal with financially. It's expensive. It's crazy. Okay. Last rule about the life insurance is getting, space bar when I didn't need it. Life insurance is cheaper when you are young and healthy. Okay. So it's not a bad plan. And a lot of times there's, you're a young family, so you don't have a lot of extra for premiums. So maybe you and your spouse, one of you decides to get at least some insurance. Not a lot. But what's good about that is getting the insurance when you're young and you're healthy. You can go back to the insurance company later and say, we'd like to add on this much. We want to increase how much we have because you have an existing relationship with them. Okay. Okay. Now, there are some types of life insurance. Okay, there are some types of life insurance. And what goes on with these types kind of is different. Each form differs, in how long they provide coverage and whether they benefit. Oh, they provide benefits, sorry. for things other than death. And there are some life, and we're going to learn about the different types of life insurance. Okay. Let me move this up. In the wrong way. This way. Okay, the first type of life insurance is called whole life insurance. It is sometimes called permanent life insurance. So both of these are interchangeable terms. Okay? Whole life and permanent life mean the same thing when you see them. Okay. Now, whole life provides insurance as long as the policyholder pays the premiums, which kind of makes sense. They build savings over time by having part of the premium go into an account for investment. Okay. So they combine life insurance payout at the end of your life with a little bit of savings along the way, a little bit of investment along the way. Okay. Because of that building up savings, they build up cash value, which can be borrowed from in an emergency at a fee, never for free. Okay. This cash value can be used as the policyholder gets older. Oops, I can spell. To pay the premiums. Okay, so basically what happens is you let the insurance company know that I've reached the point where my cash value is enough to pay for my premiums now. So what they end up doing is they switch it over. So then they start subtracting from that cash value the amount of the premium. So basically you're like prepaying those years later worth of premium. It goes into that investment account. Okay. The last thing about this policy is it can be used as a source of liquidity and investment. So when you're looking at your net worth, which we learned several chapters ago, our net worth, you do put this cash value for your insurance policy into your asset column. Okay, into your asset column. Oh, no, the employer offering it is just an offer. If you want to use that, fine. If you don't want to use it, fine. It just gives you another option for where to get your life insurance. Many of us have our own life insurance policy, and we took out the little small one through the school district. So that was like our final expense one. Usually the one you get from your employers is not going to be as big of an option. So you might be able to get from your employer an insurance policy up to $50,000 maximum, which that's not even, that might be 1 year worth of income. But it's still better for your dependents that you have something. Okay, it's just an option. It's an option. Okay. All right. Our next type of life insurance is called term insurance. It's called term insurance. And just like its name says, only for a specific period of time, usually between 5 and 10 years. Okay. Oh, 5 and 20 years. Sorry. Okay. It needs to be renegotiated. It's one of those words you have to renegotiated when the time expires. Okay. So say you have a 5-year term. What that means is they're locking in a certain percentage, they're locking in a certain premium value for that time period. And at the end of that time period, you need to renegotiate the terms of the policy. So you renegotiated for new premium when we've done. Okay. So you're renegotiating for a new premium when the time expires. Okay. So they lock in a premium value. You pay that exact number for however term you pick, 5-year, 10-year, 20-year. You pay that premium value. And at the end of that time period, you have to renegotiate, and they could raise your premium rate. Things could be going well. Your health could be really well. They could lower your premium rate, but you have to go through the process again, is what it is. Okay. Because of that, it builds no cash value. Okay, you're paying the exact premium, and that's all you're paying. You're not paying any extra. You're not building up anything. It is not considered an investment for net worth. Okay, so it is just considered a liability. It's just money out of your pocket. It's not considered money in. Because for you, the policyholder, you will never get that money. That's never part of what you get. All right. So if it's not part of what you get, it's not an asset for you. You don't own it. It's actually something that's set aside for your dependents. So it would be an asset to them when you pass, but it's not an asset for you. So that's why it cannot be considered an investment for your net worth. Okay. Okay. The plus of this, the premiums are cheaper. Because you're not putting extra in towards an investment. So with the whole life, say your premium is $300 a month, they will have set it up so that say 100 of that is towards the investment side and 200 is the premium side. But for term, the 300 is the 300. It's only for the policy. Okay. All right, so then our last type. It is called universal life insurance. Okay, universal life insurance. It's kind of a hybrid between the two. It provides coverage for a specific amount of time and builds up a savings. Oops. For the policyholder. Okay. This situation, oops, that should have an S on the end. This situation is more flexible. It allows for more flexibility. Okay. You can add on units to the term part of the coverage as you go. So say you got a universal life policy and you're young. So you got yourself a $50,000 policy. Okay. But you were young and that was a cheaper policy. And now you're in your 40s, you have 3 kids, you got a wife, you need to protect more assets. So you go back to the insurance company and say, hey, I want to up that from 50,000 to 250,000. That's what they mean by adding on units. They're adding on amount that they would pay out. Units are often in groups of 1,000. So for each 1,000, that's a unit for the insurance company. Okay. So it allows you to add on this extra as you grow older and as life changes. You can add it in or subtract it out. It allows you to do that. You can alter the payments for premium to suit your life situation. Okay, so you're young, you don't have a lot of extra. So you got the $50,000 policy, and if it was just term life, it'd be say $150 a month, but you can afford $200 a month. So then that goes ahead and that 50 is going into the investment thing. Life gets better, things go better. You go up in policy value, 250,000, right? That's going to make your premium go up, and you go up in how much you're putting into your savings. Okay. Then things happen and you have to come back down. So the universal life will let you slide up and slide down. It is in chunks of about every 5 years that you're allowed to be doing that. You can't just do it on the fly. But you have more flexibility. Term life, it's for this specific period, then you have to renegotiate. Whole life, it's for your whole life. And you're stuck with that premium and you're stuck with that. Okay. So this is kind of a blend between the two. It gives you time periods in between that you can be doing adjustments if you need to. Okay. Time periods in between that lets you do adjustments. Okay. It may allow you to pay, extra to get a bigger investment. Okay. Remember, the investment is what goes towards your personal net worth. And it may allow you to say where that money is invested. Okay. Whereas with whole life, you have the money going in, the extras going in, it's going into this investment account. They're controlling that completely. You don't have any say on what companies they invest that money in or anything like that. With universal life, you can go ahead and do the extra and say, hey, I want that extra going to the tech stocks, or hey, I want that extra going towards, okay. You have a little bit of flexibility and control about where that money is being invested for you. Okay. All right. Questions about that so far? We have one more piece of the notes. Twice. Getting insurance. That's what we're going to talk about now, getting insurance. Okay, so 1 minute, I have to let a student who's significantly tardy into the room. Okay, so there are laws, not a capital, that allow people who leave a job to continue accessing the company insurance coverage. Okay, super tardy. We're almost done with notes. Okay, there are laws that let you do that. There are laws that protect the employee in that situation. The first law, and I'm going to spell it out and then I'm going to use the acronym for it. Okay, the first law is health insurance portability and accountability Act. Okay. It's abbreviated HIPPA. Don't know why the second P. Or no, HIPAA. Sorry. Most of the professionals in the industry just call it HIPAA. Okay. This ensures continued coverage, even if switched jobs so you don't get denied coverage for pre-existing conditions. Remember, we talked about pre-existing conditions. That's what makes it so that just because you're switching from one company to the next and one insurance policy to the next, they can't try and claim that your sicknesses and your life circumstances from your previous job life make it so you're not coverable. Okay. They can't go ahead and now deny the coverage or deny certain situations, certain conditions you have because you switched a job. Okay. Okay, the next one, the next law is called Consolidated Omnibus plus, let me spell it all out, Budget Reconciliation Act. Can't spell reconciliation. This is why spell check is great. This is called COBRA. Okay. This allows health insurance coverage for up to 18 months after employment ends. Oops, employment. After employment ends, but you pay the premium now completely. So you're completely responsible for the premium. It allows you to stay on their policy, but they're not going to pay their part towards it. You have to pay the whole thing. So, like we talked before, some employers give you full medical coverage. They pay for all of it. Some companies pay for part of it. You pay for part of it. Okay. Either one of those situations, if you leave your employment with them and you're still looking for another job, you can stay on their policy for up to 18 months, but you have to pay the whole thing now. Okay, they're not going to pay their part at all. Okay, it just gives you that time to find another coverage. Okay, now there are some companies that continue to offer benefits, offer coverage after you retire. Not all of them, but some do. Okay. Either way, you're protected. Because if you retire, you could take advantage of COBRA until you get something else. Okay. Big thought. Availability, if I can spell it right. Availability. Oh, spelling today is really bad. To access health benefits should be considered when you are thinking of working for a particular company. When you're evaluating whether you want to work with that company, you want to be asking the questions. What kind of benefits do I have? What kind of health insurance do I have? Am I going to pay for the whole health insurance, or are you going to pay for part? Okay. You want to be asking those hard questions, even though it seems super weird, because if you are looking at working for company A versus company B, okay, two similar companies, same kind of job. Company A might offer you more cash value, but might not pay for your medical insurance, might not pay for dental and vision. You have to pay for that totally out of your pocket. Company B might be paying you a little bit less, but they're covering those. You have to look to see, is the cash value difference enough to cover those expenses? And remember, they're not cheap. It's not cheap. You want to make sure that you're protected and that you're getting the best deal. Okay. Okay, now some companies offer additional types of insurance. Let me put that in there. Some companies offer additional types of insurance. Okay. I'm going to go ahead and put a page break there because I don't like that on a separate page. It's totally up to you though. It's going to have bullet points on it. I'm one of those, you know, it bugs me. I don't need this little arrow here. Okay, so they offer different kinds of insurance. One type of additional insurance is disability insurance. Okay, one type of insurance is disability insurance. Disability insurance gives regular payments to cover the loss of income if you are injured or ill and cannot work. Okay. For an extended period of time. Okay. For an extended period of time. So if you get hurt, maybe you're in a car accident and you have to do physical therapy and there's all these things involved and you're not physically able to work, you have that disability insurance that'll be giving you regular payments to offset that loss of income. Or, okay, there's also cancer insurance. Exactly what it says. It gives payments to cover treatment and loss of income because of cancer. Okay, so we all know cancer happens. It just happens. And there are different kinds of cancer, and some cancers are treatable and some cancers aren't. The cancer insurance is to cover some of those expenses and to give some ongoing income while you go through the treatments and stuff. Okay. Another one we've already kind of talked about is dental and vision insurance. One or both, dental or vision insurance. And supplemental. Okay. Dental, vision, and supplemental insurance. Now, dental vision is exactly what it sounds like. It is to covers the cost of dental visits and procedures. Covers the cost of vision care, like your glasses and your eye exams and things like that. And it covers additional expenses that the regular insurance doesn't pay for. Like we talked about yesterday, that there's co-pays and there's out-of-pockets and stuff like that. If you get in a supplemental policy, that policy will help pay for part of those. Okay, those supplemental policies do that. Okay, any questions? Anybody need me to clarify something? I'll move this up a little bit. Okay, so If you're done typing, turn it in. Make sure you turn in on the document and turn in on the Google Classroom, please. Okay, make sure you turn in on the document and turn in on the Google Classroom. Okay, are we good to go? Can I switch to discussing the assignment or? Did the assignment show up? So it's chapter 7, activity 2. Did that show up? Did chapter 7, activity 2 show up? Okay. Are we good with the notes? Can we hit turn in, please? Does anybody still need the notes up there? Because I'd like to be able to go discuss the assignment. Okay, so I'm going to switch over to the assignment. Oops, right, I did the wrong thing. Google Classroom. Okay, so for assignment 2, let me go over the instructions with you. Okay, so you have some articles, 3 of them to be exact. Okay, you have a blank Google Doc. So get the blank Google Doc open. And you are going to be writing a paragraph for each of the articles. Or correction, a paragraph for 2 different things. Okay, first paragraph is about this term whole insurance article. You're going to read that article and you're going to do a little bit of an explanation between the difference between whole life and term life. Okay. And when should you get the insurance and when should you, which type should you get? Okay. And it's about you. So I should see I need, they should be I things in it. Please make sure you're referencing the article in your paragraph. Okay. Second paragraph, you are going to be writing a paragraph about explaining why car insurance is important for you and a summary between the trade-offs between the deductible versus the premium. I'm going to be fixing this. It is only 2 paragraphs, not 3. The 2 car ones, top 10 reasons you need car insurance and the car activity resource, those 2 are referenced in the second article, second paragraph. So there's only 2. Okay, there's only 2. A paragraph about whole versus life and which one you need and when are you going to need it. Okay, and then a paragraph about the car insurance. Why would car insurance be important for you? And a summary, quick summary about the trade-off between the 2. So there's only 2 paragraphs, one about the whole life versus term life and one about the car insurance. Okay, only 2 paragraphs. And it's on the blank Google Doc that I gave you. Okay. So do we have any questions about what's expected for the assignment? Do we have any questions about what's expected for the assignment?